Good afternoon, everybody. Thank you so much for joining us today. We've pretty much got a full house here in Hudson Yards. I know we have a couple hundred additional people joining us all over the country via webcast. And we're really looking forward to sharing some insights and some expert perspectives from Andrew at Cooley and Yoni from Slow Ventures. And we want to make this very collaborative, okay? So we're going to try to have a conversation up here. If you have questions, we're going to reserve some time for questions at the end. And for people who are joining virtually, there's going to be an option to submit questions using the Q&A button. So feel free to go ahead and do that. We are recording the session, so we'll be able to share the video link afterwards. And we'll be sharing the materials as well that we're presenting today. So to start, huge thank you to our partners at Cooley. If we could do like a little kind of applause for them. Longtime partners with SVB, definitely friends of founders as well. And thank you for hosting us in this beautiful space. I'll turn it over to Andrew to share a few words.
Yeah, thanks, Patrick. And thanks, everyone, for coming here today. I'm excited to join this panel. And thank you to Patrick for inviting me to speak about my favorite topic, which is fundraising. Fundraising is one area where lawyers at firms like Cooley or other peer firms can add a ton of value early on. Some founders may think that kind of fundraising is a really commoditized process and there's not a lot of innovation to it early on, but making sure you have a sound governance structure and that you're buttoned up from a documentation perspective will really help you as you raise from more sophisticated investors, growth stage investors, and when you ultimately pursue an M&A exit. So really excited to be up here and chat about kind of how to best position yourself and also some of the trends we're seeing in the market today.
Awesome. So I know several of the people in this room, but for those of you I haven't had the chance to meet, Patrick, I basically run a founder success team focused on a number of the East Coast markets that the bank serves, kind of ranging from Boston, New York, DC, Atlanta, Miami, Austin, Chicago, kind of roughly that territory. Have been a part of SVB since 2017. Initially was part of an enterprise software lending team, deploying growth capital and other credit facilities to support predominantly Series A and B companies in NorCal. Worked in a few other roles in the bank and have been part of our startup banking group, again, focused on that value beyond banking founder success piece for about the last 2 years. The way that we like to position ourselves and our mission is really to increase the probability of your success. And so a huge focus for me, for my team, for kind of the broader bank is around how can we really deliver value to clients? How can we help you, raise capital, build your customer base, acquire talent, engage our partner ecosystem. And so we do a lot of events like this focused on investor readiness and fundraising workshops, demo days, pitch sessions. We make lots of one-on-one founder VC intros, hosting mixers and dinners. We do a lot of pitch deck prep, and we'll get into some of the tactical things we do there a little bit later on. But I just want you to know that we're here to be a resource for you. SVB's success is intertwined with our client success. We like to say that we grow alongside the companies that we serve. I'm joined by a colleague, Bo Wren, in the room over here. Many of you would recognize Bo. She's hosted a number of these fundraising workshops in the past. Huge friend to founders as well. And we're here to be a resource for you. Now, with that, I'd like to go ahead and introduce our fundraising workshop guest today, Yoni from Slow Ventures.
Hi, thank you. Thank you for having me. So before I get into it, I would just be remiss not to say SVB is our bank, Cooley is our law firm. I've known Bo for 8-10 years, something like that. So these are, I think, exactly as they both said, like people who are very deep in the ecosystem as allies to founders in the innovation economy. And there's a lot of ways that you can do the work that we're going to talk about here. There's a lot of ways you can do it right, and like probably 10 times more ways you can do it wrong. And it is very easy to brush some of the stuff off as being boring and a time suck, and it gets in the way, and I just want to go. And then you wind up hitting some kind of wall because you have a totally busted cap table or, literally right now I'm dealing with a situation with a company that the round is committed and they can't accept the money because they don't have a US bank account. So like, these are all things that are real and can happen and are worth paying attention to and getting right so that you can do the things that you actually care about, which is, building your business. So very quickly, I come from Slow Ventures. We are a seed and pre-seed fund here in the US. We're spread across San Francisco, Boston, and New York. I like to jokingly say that I am the executive vice president of Slow New York. There's only two of us here. Well, I'm hoping for the chairman spot one day. We invest across sectors. Much of our history is, spelled out here. A couple guys who were early at Facebook. Kevin, probably most notably, he was like employee number 10, and Sam was like a global product VP who's after his company got acquired into Facebook. We get really excited about backing things that feel like they are, real true venture bets or, risk bets kind of at the edge of or pre-consensus. That's where we get really excited. Sometimes we talk about it as the wild, weird, and wonderful. I think it's a little bit cheesy. I just try and say, good risk and a lot of it. And we've backed, you can see up here, we've backed companies ranging from, a whole wave of consumer companies over the last decade to kind of enterprise companies in the middle, and now a lot of like weird sort of hybrid operating companies and stuff like that. So very quickly on how we invest and what we do. We often like to talk about this as, themes, not categories. So we are generalists. We try and think about, sort of some of the big important stories happening over, a period of years or decade, and then find all of the different places that we can make bets on those stories. So much more thematic rather than saying, oh, I'm the fintech guy, or I'm the, cybersecurity woman, or whatever. We're trying to think, about where we can find really good, we talk about it as venture risk. And by the way, I'm going to use a lot of language today that's probably like very much from my seat as an investor. My hope is that it's not totally alienating and instead can be maybe a little bit illuminating about how an investor is going to talk and think about your business. If it is verging on sort of cryptic and obscure, raise your hand and I'll turn the dial to like more human speak. I think second principle for us that we care about a lot is like avoid hype cycle. There are people who operate more like heat-seeking missiles, and a way I love that I've heard this described is there's heat-seeking missiles and truffle pigs, and we are truffle pigs, and we want to try and kind of root around in the dirt and like find something really rich and tasty. We don't do any outbound at all. Everything that we see comes to us. We work very hard to be like in communities and in rooms and put our ideas out in the world so that the right things come to us. We're just too small of a team and investing too early to be able to meet, 50 or 100 companies in a week. We need to meet the 10 companies that we want to meet each week, every week. And if we go to the next slide, and then we don't take board seats. We don't think seed companies should have boards. We can talk about this. This is not a consensus view. This is something that we disagree with a lot of our peers and colleagues about. We generally believe that it's, a much better idea to just like, what goes around comes around. Let's all just, try and remember that this is an iterative game and like, we're all going to be doing this together for a decade. And so, reputation matters. And then the final thing is like, this is, one of the advantages that we think that we have as a pure seed fund is not just the ability to get in early, but also to get out. So, our business requires us to eventually sell things. That's how we make money. And we're getting increasingly comfortable doing it.
Awesome. So in terms of flow, what we're going to do now is we're going to get into a couple slides that just provide a high level view of what we're seeing in the markets. So, investment trends, a few projections for where we see things progressing. And then from there, we're going to get back into a few tactics around how to effectively put together your fundraise. So to start, it's been a challenging market, right? And the reason why, among many others, is that a lot of venture fundraising really fell off a cliff following the boom years of 2021 and 2022. Now, there is a whole lot of excitement, obviously, around AI. I mean, it feels like everything is AI driven these days. And so we are forecasting that if that continues, we're actually going to see venture funding continue its recovery over the next couple of years, and getting pretty close to the peak years where we were seeing over 300 billion deployed into the ecosystem. And one of the things that we're looking at to kind of draw that forecast was sort of the growth of mobile following the global financial crisis. And so while a lot of the venture ecosystem stayed relatively flat, there was an explosion in mobile. There are a lot of similarities now that we're seeing really on the AI side. To just level set in terms of terminology, because the goalposts oftentimes feel like they're moving. We typically are referring to pre-seed as being anything under about 2.5 million, a seed being anything under 6, and then Series A typically is north of 10. We're really going to be focusing a lot of this session around how to approach raising your pre-seed or your seed, and kind of what's important for investors and what they're looking for to make you stand out from the crowd there. Now, in terms of some of the fundraising metrics we're seeing, one of the good news is that deal sizes for seed are continuing to grow. So while it's a challenging market out there, it's not like the fundraising or the financing is completely dried up. And actually, a lot of these dollars are going even further because the CapEx requirements to start and run a lot of these companies have also been decreasing. And so there's definitely some deflationary effects going on with just the rollout of a lot of these tools. And so, I think one of the things and one of the questions I had for Andrew is you're working with, companies really kind of at the pre-seed, and this is showing sort of like the median sort of rounds that we're seeing. How do you think about how much a company should raise and whether or not there should even be a target around that?
Yeah, I guess I don't really necessarily think about it as a specific raise target, but based on kind of their forecasts, will they be able to have enough cash runway for 18 months, 2 years, 3 years? Because the windows in which companies can raise are becoming a lot more stretched out than they were 3-4 years ago. So I think my advice generally is to be less valuation sensitive and take the money that you can get. And companies have become more disciplined with their cash and, generally should think about preserving money and taking money while they can get it.
So one of the pieces of advice I often give is that there's generally, some kind of, so first of all, at really early stage financing, and I think we'll talk more about this later, like the tail wags the dog, meaning you can expect to basically be selling a certain amount of, I think it was even on the last slide of like, hey, here's roughly the amount of value of dilution you can expect to take. And the tail basically wags the dog, meaning valuation is largely driven by the amount that you're raising within some, band. Mm-hmm. And so one of the ways that I try and help founders early is to be mindful of that reality and recognize that what that means is that you're almost certainly going to be selling the same amount of your company, regardless of how much money you're raising. Again, within, some error bar. So that means that like, if you're raising $1 million, you're probably doing it at 8. And if you're raising, which is whatever, like 12% of the company. And if you're raising, and if you're raising 2 million, you're probably raising it for roughly the same dilution. Maybe it's 15% or something like that. And so I think there can be a level or a temptation for like some false precision around, like trying to signal something about frugality or like, the business is only worth this much, so I only want to raise this much. As an investor, I would rather see the valuation go up a little bit and have you raise enough money to actually accomplish something, because the worst possible thing is that you're partially funded to a goal. Mm-hmm. And we've essentially built a bridge to nowhere. So you're like, as soon as you start doing like a DCF and trying to figure out like, what's my business really worth, you have already overshot and overthought. Mm-hmm. Again, the tail wags the dog here.
Yeah, and sort of related to that, I think Andrew touched on the point. On this next slide, we're just talking about the median time that we're seeing between rounds. And you can see that across the board, that has really ticked up. And so as you are looking at the amount to raise, minimum 2.5 years of runway, ideally closer to 3 years. It's something to also consider and to have a really crisp idea in terms of, what are the deliverables that you're going to be trying to prove out or disprove, the hypotheses on your roadmap, and having kind of a pretty good idea of the capital that's going to be required to get yes or no's from those experiments. One other thing that we've seen also as a reflection is a huge increase in the number of seed extensions. So today, seed extensions are accounting for roughly a third of all seed deals, and more than a third of all capital that's being invested into the seed. I don't know if either of you guys have any thoughts in terms of, if you have a seed-backed company, how should they think about, whether going down the seed extension route versus trying to do an A, what have you?
From my perspective, it seems, and Yoni could probably speak to this better, it seems like the kind of hurdle to raising a Series A has increased a lot. So a lot of companies that are really promising at the seed stage, that are showing really remarkable growth, are continuing to raise kind of flat seed extensions because the hurdle for a quality Series A has risen so much.
Yeah, I think that's exactly right. Where, maybe 4 or 5 years ago, there were rough but reasonably accurate heuristics of saying, you get to like $1 million in revenue and the Series A unlocks, and then sort of over the last couple of years, it's like, maybe it's $1.5 million, or maybe it's 2 million. And I think increasingly today, the answer is that it's not really numerically derived as much as it's a feeling about momentum and the ability to replicate exciting results at greater scale. And that means that the exact barriers are fairly fuzzy. They're obviously category dependent. And like $1 of revenue is not worth the same thing in every context. There's both for real financial reasons, and then for more sort of narrative and story reasons. We are certainly seeing, we sometimes talk about this as the seed regatta. I don't sail, so I'm going to probably get this analogy wrong, but people who have made more money than I have and do sail have explained it to me. So I'll try and do my best, which is that a regatta is a sailing race. And before you actually start, there's a process basically of like tacking around at the starting line, sort of jockeying and jostling for position. And effectively, that's how we see the seed market evolving, is that like before you get to the real like starting gun of a Series A and sort of going for scale, there's a lot of this sort of tacking and jostling that goes around. And that might mean raising multiple rounds of sort of small or interim amounts to get to kind of interim milestones along the way, often as expressed, we did a pre-seed, and then we did a seed, and then we reopened the seed for a little bit, and then we did a seed extension at a little bit more. I think I have a slide on this later, but the way that I basically see these kinds of rounds is that a pre-seed round is a business that has a direction, but no hypotheses. And so it's really a research project to arrive at the testable hypotheses, but rarely to test them. A seed round has hypotheses, but no data, no proof. And so we're going to spend against proof. And then a seed extension is often a situation in which you have data, but no significance. And so you just need to get more data back so that you can not just say that we did it, but confidently say that it's done. So I see a lot as those sort of, as the lines move, I'm seeing a lot more of the seed extensions that you guys are talking about.
Yep. Oops. And then just the last slide that we have in this section is really just getting into the valuation aspect. Yoni, one of the things that we were discussing is particularly the early stage, it's almost always better to go the safe route, to try to avoid thinking about priced rounds, to even try to avoid thinking about valuation, although that is a pretty easy thing to back into based on whatever you're raising and the dilution that you're giving up to it. Is there anything you wanted to add to that?
Yeah, just like, and I don't mean to step on toes here, but lawyers are expensive, and
Not wrong.
and they're worth every penny. No, actually, seriously, they like literally are. I the number of times I've sat across from teams and we've closed around and I've said, you have to fire your attorney and hire like a real Silicon Valley attorney. Do not use your dad's friend who did corporate law at a private, like, just don't do that. It will not serve you well over the long term. There's like 5 law firms that you should use. Don't use anyone who's not one of those 5. That's really not a joke. You will pay for it in the end. Yeah, I think like lawyers are expensive, and priced rounds can take a long time, and it's often just not worth it, the drag on the money that you're raising and the time that you want to get it in to like do real docs. At some point you have to do them. If you raise, at this point, you will almost certainly raise that on a YC safe. If it's not a YC safe, you should ask why. This is not legal advice. You should ask why. It should be a YC safe. The way that YC safes are structured right now is they're all post money and with no discount, which means, or they're almost always, which means that as you raise successive rounds on a safe, you are bearing that dilution, your investors are not. So at some point you want to actually issue shares, but like for the first round that goes into your business, unless you're raising more than like $3 million or something, just do a safe, save yourself time and money.
Great. Yeah, and just to kind of tack onto that, totally agree with you on sort of the 2.5 to 3 million. We always sort of recommend to our clients that they do a safe rather than a price round when you're raising a lesser amount, particularly if it's a firm like Slow where you're not putting in place governance or a board. The one cautionary point is if you're going to be raising multiple safes over sort of a longer period of time, the dilution that you can incur can be sort of deceptive. So generally like one round of safes is a good idea, but two, maybe tread lightly.
Agreed.
Great. So for here, this was kind of fun. When Yoni and I were talking through this the other day, he was reminded that about a year ago, I think he had started putting together some really interesting pages around the philosophy of a seed investor. And so he's been able to repurpose a little bit of that content. And what I think is really cool here is it helps get you inside the mind of the VC. And so it's very much the VC's perspective in terms of, how they're approaching the process.
Yeah, so this is a slide I took from Aaron Harris. This is real data from Aaron's like a sort of advisor to startups, and he helps them raise Series A's. This is real data from a Series A that he helped run. So it's a Series A, it's not a seed round, but I think it's generally illustrative and is like a useful table setting of this, of like, it was 100 investors that they pinged outbound. And I should have put a link to it or something at the bottom, but he tweeted this photo maybe a couple weeks ago. And he's just Aaron Harris on Twitter, or X, the everything app. I mean, I just think it's illustrative of like the volume that you need to be operating at. And honestly, for a seed round, the error bars are very wide, where you may need twice as much volume as this, or you may need like 1/10, and you just get, there have been instances where I've been the only investor that a company ever talks to. And there have been instances where I've literally been the 100th investor that they spoke to. I think the famous story in Peloton's fundraise was that they like pitched like 400 people or something, before they got that together. So like, but this is like what a good process roughly looks like. Anyway, so like some very quick, can you go to the next slide? Some like very quick, just process tips on like how advice that I would literally give to anyone who's fundraising. Number one, like call it whatever you want, Sherpa, Rabbi, Copilot, like everyone needs someone to help them run their process, which is both like someone who has done this before and crucially someone who can like initiate the intros. It's trite and it's frustrating, and it will be frustrating for you, but a warm introduction is immeasurably more valuable than reaching out cold. I have invested off of, cold inbound that comes to me from a founder. Most of the time though, it comes in from someone that I know. And so who are the people in your network who you can activate? And maybe that's the angel investor who commits first, or maybe it's, the CEO of the company that you just left, or maybe it's your friend who's raised money before, something. And sometimes it's multiple people, but who can help you. Patrick will have some slides on this later, I think, about like, putting together a CRM and, thinking of this is a sales process like any other. The difference between this and probably any other sale process, it's more like selling a house than it is selling your product. You only get to sell it once, at least in this round. So the most important thing is getting any term sheet or any offer from anyone at any terms as quickly as possible. Because you have no leverage until that happens. No one has any incentive to act first. I look stupid when I'm wrong. I look moderately less stupid if other people are also wrong. So I like, this is just the sort of social nature of the beast. the most important thing is getting any offer from anyone at any price, which then helps you drive the process and be able to tell people, hey, there is an offer on the table and we're going to make a decision by X date. Third, anything that gives anyone any reason to bow out quickly will lead to people bowing out quickly. So if that's you telling someone, hey, we're meeting on a Monday and I'm looking to make a decision on Tuesday. We're called Slow Ventures. It's a really easy excuse. Thank you. Hey, I want to raise $7 million. Well, my max check size is 3 and I can't really lead around if I'm not taking half of it. Like, it's fine. We're seeking a $50 million valuation. I can't really get the ownership that I want. The way that you wind up actually getting those things of a fast moving process and a big round and high valuation is by having multiple bidders. And the way that you have multiple bidders is by being as biddable as possible to the maximum number of people. So you need to, honestly, the best thing to do tactically on this point is be a little bit vague. When is the round closing? We have some interested people and we're excited about the momentum. How much are you raising? It's like 3 to 4, but we're excited about some opportunities where we could raise some more if the right, thing comes together. What's the valuation that you want? We want to do what's right for the company and our existing shareholders. In the end of the day, what really matters most is who we partner with. Like, these are all kind of, am I allowed to swear? Mm-hmm. These are all kind of bullshitty things, but they're also true and they make you more biddable to more people. And this last point is really, really important and it's very easy to forget. You are not merely selling your stock. You are selling a story and people want it. There's a reason why VCs, they don't say, I bought stock in Patrick's company. They say, I partnered with Patrick and I'm excited to partner with him to help build his company. I'm obviously not building the company. I contribute nothing besides money.
So going along the lines of multiple bidders, can you share with founders like how you can social engineer FOMO with real FOMO versus fake FOMO? Because I've seen founders run with this and be like, we got a term sheet from XYZ.
Do not lie. Do not lie. Lying is very bad. If you lie, I will never trust you again. And it's very easy to verify whether or not you've lied. You also probably, if you actually do get a term sheet, probably has some confidentiality language in it. And if you break that confidentiality language, the person who offered it to you will probably be very upset with you. So this is my point on trying to be vague and indicative, because the opposite of that is either revealing your hand as I have no leverage and probably at this point, no firm interest. People will say things to you like, I'm really excited about this. We'd love to think about what an offer might look like. And that will sound to you like a verbal offer. It is not a verbal offer. That is someone not doing anything dishonest or evil or bad. That is someone trying to keep you engaged so that they buy more time to do more work to make a better decision. So if you respond to that, if you take that to someone else and say, we just got a verbal offer, so you need to, do your business or get off the pot.
Oh, we were swearing.
Yeah, well, it's like a church. That is a really, when most of the time when someone says that to me, I will call their bluff, because I'm just like, cool, you have the number of emails I've sent, and I'm not trying to be nasty to anyone, where I just say like, hey, if you have an offer, you should probably take it, because I'm not going to get there in 24 hours. Like, I want to be thoughtful. We are making a decade-long commitment together. If it works, honestly, it's not a decade, it's 15-year commitment. That is how I think Figma's going public after 14 years or something like that. So if someone wants to try and artificially rush me most of the time, or if someone wants to rush me most of the time, it won't work. So if they don't have an offer that's actually real, they are just reduced the number of bidders in their process by 1. I think that's fairly universal. The way that you get real FOMO is when you're willing to actually exercise it and fire the bullet, which you can only do if you have a bullet, which means that you actually have to have the offer. So if you say, we have a term sheet, we are excited about it, we have multiple term sheets, we are going to make a decision by this date, totally respect that you need to run your process. If we can get you along on that timeline, please let us know. Again, because to my final point, you're not merely selling stock, you're partnering with people. You need to include them, not be oppositional, not be confrontational. You do not want to get into a position where you have raised money from someone but in the process have deteriorated a relationship with them such that there's like not openness and honesty and trust. That doesn't mean you need to like spill your guts the first time you meet someone, or like let them, you know, truly in on all the dirty startups are dirty and messy and nothing ever works and it's all failing all the time. That's fine. But like there are ways to make people act with urgency if and when you actually do have the leverage that don't rely on trying to, you know, exploit, confront, or manipulate by just presenting. If you actually have leverage, just present it honestly. And again, honesty works, don't lie.
You know, extrapolating that a little bit further, I'll often hear about, you know, getting LOIs. And I kind of, at this point, just refer to those as letters of insignificance.
What is an LOI? And
letter of intent.
No, but people do LOIs for startup financing.
I will often hear that, like, in terms of being framed as kind of like a verbal offer akin to that. And I guess also extrapolating a bit on what you were saying, you know, I think a lot of conventional wisdom has been, oh, you want to go find your lead. And once you get your lead, everything else is going to fall into place. I don't think you really share that view.
So that is a right answer. I don't think it's the right answer. To my prior point on Sherpa Rabbi Copilot, there are oftentimes the way that rounds come together is you go and focus and find the lead first. And the lead says, hey, we're going to do, you know, 1.5 of the 2 million. We'll go and help you find the remaining 500. You know, it'll maybe be 300 from a smaller fund and 200 from a mix of angels. That's great. And when that happens, that's really, really great. Sometimes, and I think, you know, maybe even often, there are smaller firms, you know, the person writing the 200 or 300 or $1 million check that can't lead the round, who know that their only way to secure access and an allocation is by helping you find the lead, because they know if they bring me the deal, I am not going to step on their toes and box them out. I'm going to ensure that they get whatever piece of it that they want because they've done me a great service and favor. So I think it often find the lead first. It is also viable to have someone else who can help catalyze it. The caveat to this is to not walk into the meeting with the person you want to be the lead and say that there's already terms in place, because it's like, well, I don't know, maybe that's not the valuation I want. Maybe that's not the amount I want you to raise. Maybe I don't want it to be a priced round. Maybe whatever. The same goes for board stuff. Be very, very cautious and careful about who you let on your board. Again, you're like dad's buddy who used to work in private equity and is cutting a personal check into the business should not be on your board. Your customer, who's going to be the anchor customer for the business, should not be on your board. Probably no one should be on your board except for you and your co-founder, and leave things clean and let you and the lead investor figure it out. Don't have a founder chairman of the person who just keep things as clean and simple as possible. I mean,
I totally agree. I think keeping things generally as simple as possible, as clean as possible early makes sense. Is there an advantage to having like an independent director or a subject matter expert early? Maybe sometimes if it helps unlock sales, but I think as a founder, you're trying to optimize for keeping common control of the board and sort of deferring stacking the board with investors and non-founders.
Yeah, we at Slow we basically we invest so early that we effectively view ourselves as buying common. We think it's in our best interest for companies to be under common control for as long as possible. It's our belief that if we set a precedent by joining the board, it just means that your next investor is also going to join the board for sure. And it just brings us like a couple years earlier to losing common control of the board. We find that it's just in our best interest to be maximally aligned with founders in terms of both governance and economics. I would buy common stock if I could. It's too complicated and gets into weird, tricky reasons.
Can you define common for the founders?
Oh yeah, for sure. Actually, no. You can define common.
So common stock is what you have as founders. It's it has no special preferences, no liquidation preference. It's at the bottom of the waterfall on an exit, behind debt, behind preferred stock, behind safes. And generally, it doesn't have any special rights other than the ability to designate board seats. So it's kind of the most simple vanilla type of security that the company can issue. And then sort of the more, I guess, complicated securities are securities that have special rights or preferred stock, and they tend to be issued to investors or people who are putting in capital to business.
One thing that I'm starting. Oh, sorry.
There's a question back there.
Yeah, sorry. What about the fear of losing control of their company? You guys are saying to keep the board seems pretty clear, but what about founders that are scared of losing control later on?
So there's ways you can optimize around that in your stockholder agreements when you raise a price round. But I think sort of the most clear-cut way to protect yourself from being removed is to control the board as long as you can. So not to have a majority of directors that are non-founders, and then if possible, controlling majority of the stock for as long as you can, so that you can vote the directors.
I would just also say that so the ways in my experience, and I would imagine you have a lot more experience on this, so please tell me what I'm getting wrong, but CEOs get fired very rarely. There's just massive reputational risk to the VCs firing them. It's rarely actually even worth it to do, because if we're firing the CEO, the business is probably going to fail after that. And even if or it's already failing today, and it's actually just cleaner and easier for us to do nothing. There are obviously some really high profile instances where that's not true. Like famously at Uber, they fired the CEO, which was a precondition to like realize a ton of liquidity all at once. So you probably will lose control of the company at some point, which is one of the reasons. And you usually, if you assume that at each round you're adding a preferred director, let's say you don't add a seed director because you raised from a fund like Slow. At the Series A, it's a 3-person board, 2 common, 1 pref. At the Series B, you may have 2 pref, 2 common, and potentially 1 independent director, because there's kind of do we want to have like a tiebreaker? That feels weird to have a split board. And then generally you've lost control of the board at that point. You can defer that a little bit by not having a seed board director. You can there's some stuff you can do in how the company's set up that like help retain some element of control. But the biggest thing is having people on your board who you really, really trust and are really aligned with what you're doing and believe deeply in you and will support you, and like be good faith actors, which I think is a really important thing, where there are certain social norms among VCs that may not exist among other kinds of capital providers, even those who are willing to write checks into venture rounds or venture-backed founders. So like we all are, thinking about our careers in decades and are very sensitive to the biggest guardrail basically on anything a venture capitalist is going to do is the potential damage to their reputation. And in my experience, that is a much better safeguard than anything that's, in legal docs.
Great. I think I'll go ahead and jump in then to, because I think you've already touched on a number of these points around what you're looking for, seed. But I really like this chart that you would put together.
Cool.
So maybe talk us through this.
Yeah. So I sometimes talk about, I talk about my buy box. It's a box. It has 4 sides. I care about 4 things. Falsifiable hypothesis, that we can prove true, false in like relatively small time in dollars, where a positive result matters. And there's opportunities to rerun that kind of thinking in the future on the next set of hypotheses. So like, we want to see things where we feel like we're actually buying proof of something. We want that to not cost, it's like, I don't want to have to give you $50 million in 5 years. Like, what are the sort of indicative, cheap, early, fast things we can do? How are we sure that, part of good experiment design is ensuring that not just that you get a result, it might not be the result you want, it might be a negative result. But if it's a positive result, is it important? Importance can mean a lot of different things in different contexts. And finally, like, again, there's like a big prize at the end because we can run a lot of experiments and build something really big. If you go to the next slide very quickly, this is the distinction I make between seed and pre-seed, where pre-seed rounds, in my conception of it, are usually like non-falsifiable hypotheses. So you're like doing stuff cheaply and quickly, and you have options to repeat, but rarely are you generating a real result. And so I talk about that often as being necessary, but non-economic. So meaning like we don't really get paid for taking those risks, but it's important that we take them nonetheless because it tees up the next thing. So when we're funding a pre-seed round in isolation, it's usually this kind of thing versus when we are sort of bundling a seed and pre-seed together and it's a larger seed round of, $5 or $6 million at a time. That's because we're hoping that we're going to pay for like a positive result that matters.
We have a question over here.
Do you think it's beneficial to have like the A/B testing hypothesis data in the data room for diligence, or is that overkill?
I want to think about this. I think it's overkill. And I think it's overkill. One, having a data room for a pre-seed round is even a seed round may not honestly be necessary. Like, I actually think it might be on here, or maybe it's on the next slide, but is like generally what we look for more is like, show us a deck. Maybe there's a product demo. Maybe there's like a longer version of the deck. Sorry, a product demo. And maybe there's a longer version of the deck that's more like a memo, that maybe has some Q&A. If you have a product that is launched, then by all means, we want to see some data from it. But I don't know that you need to have, here's the data room with all of our, like by the time it actually comes to closing a round, we need to see, or our lawyers need to see like employment agreements and leases and it's, certificate of incorporation and all that stuff. None of that is really going to drive our decision-making process. I would also say that you're maybe being a little too literal about the idea of like tests with falsifiable hypotheses. I think, I don't know that I believe that you like A/B test your way to really big, important things. To me, like, frankly, as a really early founder, you probably don't have the throughput to like meaningfully A/B test something because you're maybe talking about single digit users or customers or, design partners. So the kinds of hypotheses that I am more excited about would generally be things like, hey, we think that if we build this product, it will like deliver on this outcome for our customers. And, and I'm really happy and excited to see that like, oh, cool, we have successfully delivered on this outcome. Or we think if we package this product in a different way, we can like get people to buy something that they haven't bought before. Or we think that we can go to market in this new way, or like, which is maybe a little bit sort of higher level than like, let's see a series of A/B tests. And if we like run certain creative in this way, that's maybe less important versus saying, hey, I actually think that influencer marketing could work in this category in a way that people haven't tried before. I'm making this example up, to be clear.
Yeah, but like amalgamating the qualitative signals that you're getting and kind of like putting them together in this way.
I would say amalgamating them, yes. The key is that this is a lot of storytelling. And however much someone wants to be, and I would like to consider myself like, I look doing robust and structured thinking, and blah, blah, blah. Like it's still very kind of like finger in the wind, vibes based, like tell me a story. Mm-hmm. And ultimately what I really care about is like, is this a story that I'm excited about? Does it have an ending I'm excited about? And do I like the storyteller? And like, however we get there is kind of up to you. And maybe there's a lot of data and maybe there's no data. Maybe there's a product, maybe there's no product. I don't know.
I think we have another question here in the front row.
It was related. I was going to ask about the specificity of, because I've been thinking about raising money from two angles in terms of valuation. You touched on this earlier, which you can take the bottom up route, which is the next 12 months, I need to do de-risk these 3 critical unknowns, and therefore it's going to cost me 1.3 million to spend 700 of it on software, et cetera. Or you do sort of the top-down valuation route. So my question here is like, what is a level of specificity you should have in terms of a roadmap of like, I'm asking for this much and this is how I'm planning on spending it, and here's the stage appropriate outcomes that you can expect in life.
It's a really good question. I would maybe try and triangulate between the two and see if you are roughly approximating the same answer from both directions. And if not, I would be curious to know why. Most of the time in most companies that we work with, not all, if we're assuming these are like relatively like capital light businesses, they're software companies or similar, like, hey, I need $1 million because I need to, hire myself and 2 engineers for 18 months. I'm like, all right, cool. Yeah, that sounds about right. And then you have some wiggle room on top of that, and you have some contractors and like whatever. So, generally I think of the sort of unit of account in how much money people are raising as basically engineering salaries. And like, how many engineers will it take for you to do this thing over what period of time? And then are there any particular like significant, hey, maybe you're in a more regulated industry and so you're going to have a bunch of legal bills. Maybe you need to buy some physical equipment. Maybe you need to I think it's useful to have a plan that is grounded in reality. I don't necessarily find it useful to see and here's our monthly 6-year operating budget. Please give me $1 million is not that helpful. Things will change. I think being able to say, here's what we think we're going to pay people and here's how many people we need. But if you take those two answers and if you take those two approaches and you get wildly different answers, I would just be curious to know why and interrogate that a little bit.
So I think we covered a lot of the points already on just the kind of the checklist for mastering the fundraise process, but perhaps the 2 areas to double click on. One would just be around how to think about building that personal CRM, leveraging your network, getting extensions of that network to really engage investors, to track interest, even if there are specific tools that you recommend that founders use when they're sending out a pitch deck or whatever to understand engagement.
Yeah.
And then also, going back to the points that we discussed around the importance of storytelling. And the fact that, as we had discussed in our prep call for this, if you don't have an AI narrative, it's just extremely difficult.
Yeah. So, okay. Tools. Your goal is to get people to open the materials that you send them. So make it easy for people to open the materials that you send them. It is actually a good thing, not a bad thing, if those are getting passed around between people. So, I don't fully you're a seed stage company. Your true economic value of your business is $0. There is no IP to protect. There are no great secrets. Putting password protection and it just doesn't serve you. And what you actually want is people engaging with the materials that you've provided them. DocSend is fine. At this point, everyone knows how to open a DocSend. Everyone also knows how to rip a DocSend down and convert it into a PDF. I will do that. I will, there's this question of usability. If you turn on downloading within DocSend, I can then download it as a rich text PDF and then upload it to ChatGPT and then not read it and talk to the robot about it. That's how I like to interact with pitch decks. I think make things if your goal is for people to read things, make it easy for them to read things. We will cover this, I think, later. Don't send people NDAs. They will not sign them. It will end the conversation right there. Yeah, I think I don't know if there's any great tools. There's just things you can do that make things harder. So don't do those things. What was the second piece of it? I don't remember.
CRM.
Oh, yeah. On CRM, again, same thing. You want something that makes it easy for the people who are rooting for you to succeed to engage with it. So just use Airtable or Google Sheets or something that is I would not try and don't set up your own Salesforce instance to do that, because if you're asking me for help, I'm not opening that. That's too hard. So use whatever is easy for other people to interact with. Make life easy on the people who you want to help you.
Do you have a preference when founders specifically come to you? I mean, with kind of a fundraising request versus, hey, I just love your feedback on what I'm doing. Does one tact or approach work better?
So I am maybe not representative here, but I am, if you can't tell, I'm a loudmouth and I talk a lot on the internet. And I am very, very public about what I want to invest in. And so if someone reaches out to me and they say, hello, based on Slow Ventures investment in such consumer companies as Robinhood. And I'm like, I don't know, man, I was not involved with that. That was 10 years before I joined the firm. Like, pass. But if someone says, hey, I saw you wrote this thing, it was really interesting. Like, I'm kind of tinkering around and thinking about this, like, would love to find time to chat with you. I will take that very seriously. It doesn't mean I'll always take the meeting or invest or whatever, but at least take it seriously because it feels like they're reaching out to me specifically, which I appreciate. Now, it's not feasible for you to do that for every single person that you're going to reach out to. So that's fine. I think you can be relatively more targeted for the people that feel like a higher priority for you. But it's very, very clear and transparent when I get an email that's like, based on such innovative technology investments. And I'm like, what are you saying to me, man? Like, speak like a human being. I will actually also say on that point, SVB is different in this regard, but I would very strongly advise you against hiring anyone who's going to pitch themselves to you as like a fundraising guru who like has a great network and will make, as soon as someone is asking you for money to do stuff like that, that's not how this works. And they probably are scamming you. I'm not going to say 100% of the time, but pretty close. To be clear, if you're a lawyer, if you're a banker, if you're a friend, they're like, let me help you. And maybe over time, they're hoping that you will then use them as a bank or law firm or whatever. That's how people get paid for helping each other, is like over long-term relationships, not short-term transactions. We all win together, yada, 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 kumbaya. It's true, though. It's cheesy, but it's true. So don't pay people for help like that. Those emails go into the garbage. So you do need to be targeted. You want to get warm intros. Warm intros count for a lot more. If you're going to do cold intros, cold inbound, then it should be really targeted and specific.
Sorry, I was just going to ask, in your, I think your opinion or your experience, what would be like a perfect process between the founder and a fundraiser where a relationship is built, and there's not this kind of like this dance between one level of scarcity, because you talk about timing.
Yeah.
But again, as a founder, I want to know that you're in the trenches with me for 10 years. And so I look for people that are going to help me build the business versus a check. And so that's sort of how do you kind of get to know each other in that way? Yeah. And what's perfect for.
So I will answer that. I will also pre-answer that by saying, everything that you just said is important. Minimum viable is money. And there are a lot of, and money counts for a lot, and you need money to run the business. And we should all be so lucky as to have incredible investors like me who are wonderful and everyone else is terrible. But, at some point it is just money, and my money's is all money is green and all money is red. Which is also to say, some people do not have money and they will act like they have money and they will waste a lot of your time. And usually they're trying to get something from you or just trying to feel important. So personally, I don't like participating in processes. A lot of my investment has come not during a process. It's been, hey, I get introduced to someone because they know I'm interested in this idea, and maybe we get lunch and we talk about the business and we get up on the whiteboard and we like do some work together. And suddenly he wants to see my ideas on a whiteboard. He must think I'm pretty smart. Okay. And like, that's very flattering to me as someone with no skills or ability to actually build a company. It's fun to write, hard to do. And then maybe we meet up again in a couple months and, oh, hey, there's been some cool progress on this. And like, that's probably my idea. And then I get to issue a term sheet and there's no other bidders around the table. And, it's just, we love each other so much and it happens like that. That's outside of a process. Within a process, I would love to get an email from Patrick reaches out and said, hey, Yoni, I saw that my buddy from high school is working on this thing. I think it's kind of relevant to this investment that I saw you made some investments like this. And we were talking about this thing the other day. I think you'd really get I think you'd really like get this. This would be something you'd get excited about. And I'd say, oh, well, Patrick says I'd get excited about it. He's right. I am excited about this. Okay, let's maybe we get coffee, maybe we meet over Zoom, whatever. And I'm like, okay, give me a couple days. I'm going to kind of noodle back around this. And then maybe we meet again. And then I introduce you to one of my partners. And then I'm like, hey, I'm going to write something about the company, and can you read it and let me know what you think? And like, we're doing that over the course of maybe like 2 or 3 weeks. Maybe we get together in person and like, hey, and I'm like trying to understand, like, why are you building this company? Like, you're talking to me about like enterprise data security. I'm like, that's the most boring thing in the world. Like, why do you want to work on that for the rest of your life? And like, you should have an answer as to why this is something you really care about and are excited about. And like, how does this connect to like how you see the future and what motivates you? And like, all of those are moments for us to understand how each other thinks and what it feels like to work with one another. I am always trying to simulate, once we get past like first or second meeting, trying to simulate the feeling of what it looks like to actually work together, and like what it looks like to be in a board together, what it looks like to, hey, we're going to do 4 board meetings a year and 4 board dinners a year, and like, that's a lot of time to spend. Do we want to spend that much time together? It's one of the reasons we take observer seats. We can very easily pair back when it's not. But like, I don't know if that answers the question, but
I was
okay.
trying to get, what's to create a vibe?
Yeah.
That's the thing. How do you get that?
I think some of this is a personal style thing, and it will differ founder to founder and investor to investor. And hopefully you find the right person who it's dating.
Yeah.
It's dating.
And I know that we started a couple minutes late, and we're probably going to run a few minutes over. So I'm going to go ahead and just jump through a couple.
I will give faster answers.
No, this is great. I think for everybody here, you can see why I was so excited about having these 2 panelists come up on stage with me. And I would highly recommend following Yoni on Twitter or X, the everything app. Look, I think we already talked about a lot of what should be involved in a pitch deck. Although oftentimes the best meetings, you're not even going to open or use that pitch deck. It's around building the conversation.
Yeah, don't insist on flipping slide by slide through the pitch deck. If someone says, hey, I get it, listen to them and just talk.
I think one important thing though is like, do your diligence on investors. And Yoni touched on this as well. Like, know what they're investing in, know what stage, know what geography. Also know how far along the fund is. Are they still deploying? Are they still relevant? Okay, because if you're catching a fund at the wrong time, or it's just not a fit, you're just wasting time effectively. And then in terms of just like the criteria, actually, I think I'm going to go ahead and just jump down to, maybe we'll end on this slide right here. So in terms of some of the seed funding criteria, I think we touched on what are you looking for in terms of traction? How do you measure that? How important is revenue? Anything else you want to add?
Yeah, I said this earlier. These are all true. Everything that's on this list is true. Ultimately, what I said earlier is also true, which is that really it is kind of as simple as like, sometimes we talk about it as team and theme. Like, is this a story that we like? Is it a storyteller that we like? Do we think if we're right, we ultimately get paid? Is it important? If someone passes on the business, almost certainly it will not be because they found in cell 22F of your model that, gross margin was only going to get to this percentage in 2028. That's not important. If someone passes on the round, almost always it will be because at some point along the process, they lost belief in one of those 3 things: the story, the storyteller, or the end. And if you've spent a lot of time with someone along the way, it's reasonable to expect a substantive pass email. But usually that is one of the reasons. And they may be able to express that reason by saying, hey, look, we ultimately found like, we're just not sure that this is good risk for us today. It's like a cool story over the long term, but we think risk reward today, or like what, or hey, like, I really like the story. I don't know if this is the right way to make the bet on this kind of industry, or, hey, I think we'd like love to see you with a technical co-founder. Whatever the answer someone gives you, it's almost always one of those 3 things that is the answer behind the answer. It is not useful to you, or won't be useful to you, to follow up repeatedly and ask them why they're passing. I will almost never tell you. Most of the time, it's just like, I don't know, seemed fine, not that interesting. What you can maybe do sometimes, if the meeting was set up through a warmer relationship, someone that I know and trust, I probably won't say to Steve, hey, Steve, you're boring and I don't like you. What I might though do is say to Susan, who introduced me to Steve, hey, Susan, thanks so much for putting me in touch with Steve. I think it's a cool idea. I don't know that he and I ultimately really connected, and it felt like, it just didn't grab me enough to want to move on for these 3 reasons. So your best bet is to kind of work the channels rather than asking for feedback directly. You still may not get it.
Awesome. Andrew, any closing thoughts or comments from you?
Well, this is really valuable, Yoni. Not a lot to add. I think, there's a lot of value that we can add on the legal side, whether it's Cooley or another law firm. And thanks to all for joining today.
Well, yeah, once again, thank you everybody for joining. I know we didn't get through all of the content. Again, I think we touched on all of this in the talk track at least. We'll send the slides around in case you find anything else that can sort of be useful here. Last thing, I'll just call out a little bit of maybe a plug, but we actually are doing another event in this room in about 25 minutes. And so if anybody here is interested in joining for that, it's all around AI and automating finance. Working with a number of senior CFOs should be a good discussion. If that's relevant to you or something you're building, or in terms of getting in front of some of these CFOs, I'd be happy to have you stick around. Just come and find me afterwards. Sorry for the people who joined online that we weren't able to get to any of the questions that were submitted in the Q&A, but we will go through those and figure out how we can address some of those points in a future topic. So thank you again, everybody. I really appreciate you being here.
Thanks for having me.